For the past few years, it's felt like the luxury housing market was this unstoppable rocket ship, right? Well, it looks like that party might finally be over. We're about to dig into some pretty surprising new data that shows a major correction is happening at the very top of the real estate world. So let's get right into it.
And let's be super clear, we're not just talking about a little tap on the brakes here. The latest data shows something crucial. The million-dollar-plus housing market isn't just cooling, it's cooling down way faster than the rest of the country.
So what does this cool down actually look like in the real world? Well, if you take a peek at the pricier metro areas, you'll see these high-end homes are starting to just sit there. They're lingering on the market for a lot longer than they used to.
Now, we're not talking about the entire market. We've got to be specific. We're zooming in on a really influential slice, the top 10% of metro markets. These are places where the median home price is over $666,000, and it's in these areas where this correction is hitting the hardest.
The headlines, they only tell you part of the story. If you really want to understand what's going on, you have to dive into the numbers. So let's break down the key figures that are really driving this whole shift. The first number you need to know is negative 2.5%. And yeah, you heard that right, negative. That's not a gain, that's a year-over-year price drop in these high-end metro areas as of last October. While the rest of the market was kind of flat, this top tier actually saw prices fall.
And that percentage drop? It's not just an abstract number, it translates into real money. The average home price in these expensive markets dropped from $1.04 million last year down to $1.01 million this year. That's a $30,000 hit, on average. Ouch.
But it's not just about the price tag, it's also about the clock. The next key number to remember, 73.2. That's the average number of days a $1 million home is now sitting on the market before someone finally buys it.
And just how big of a change is that? Well, compared to last year, the time on market has jumped by more than 20%. Homes that used to get snatched up in a few weeks are now waiting for over 2 months to find the right buyer. So you know what happens when homes sit on the market longer, right? Sellers have to get realistic. Nearly 40% of these high-end listings have had to slash their prices just to get people interested. And that's a huge sign that sellers are not totally in the driver's seat anymore.
Okay, so let's put all these pieces together. Falling prices, homes sitting forever, more and more price cuts, it all points to one simple thing. The balance of power is shifting. It's moving away from the sellers and right into the hands of the buyers.
And we can actually measure this power shift. There's this cool tool called the Market Action Index. The easiest way to think about it is like a scoreboard for the market's tug-of-war. A high score means sellers are winning, and a low score means, you guessed it, buyers have the advantage.
And that's exactly what we're seeing. The index fell from 39.7 to 37.1. Now, I know that might not sound like a huge number, but in market terms, that's a crystal clear signal that the leverage is moving over to the buyer's side of the table.
All this data suggests that buyers aren't just getting more power, they're also getting, well, pickier. With more options on the table and more time to think, they become what one analyst called an increasingly selective buyer pool. They're not just jumping at the first shiny thing they see anymore. But just when you think you've got it all figured out, the story takes a really fascinating twist. See, this slowdown, it's not happening everywhere. Like they always say in real estate, it's all about location, location, location. And some markets are completely defying this whole trend.
I mean, just look at this contrast. On one side, you have the cooling trend we've been talking about, and then you have Honolulu, where the median price shot up by an incredible 9.5%.
And to put that into perspective for you, Honolulu's median price didn't just climb a little. It leaped from $1.31 million all the way up to $1.44 million. It's one of only 3 high-priced metros that posted strong gains, which just goes to show you that even in the luxury world, some markets play by their own set of rules.
Okay, so we've looked at the data, we've seen the power shift, and we've even checked out the exceptions to the rule. So what's the big takeaway here? What does this $1 million correction actually mean for you if you're watching the market? All right, here's the bottom line. First, the high-end market is officially in a correction, no doubt about it. Second, sellers are losing that iron grip they've had for years. Third, that means buyers, you now have more time, more options, and way more negotiating power. And finally, as Honolulu proves, you just can't paint the whole country with one brush. Local markets are still king. And all of this leaves us with the $1 million question. Quite literally, is this just a temporary blip, a little cool down after a red-hot market, or are we seeing the very beginning of a much bigger, more long-term trend? That's the question everyone in real estate is trying to answer right now. Thanks for joining us.